As a licensed insolvency trustee, I help people get out of debt. Filing a bankruptcy or consumer proposal eliminates your credit card and other debt. Now that your debt is gone, the last thing I want to see is for you to get into trouble with debt again. Let's start by talking about credit scores. You think that because you contact the credit bureaus to order your credit report, they're working for you, right? Wrong. Credit scores were created for the benefit of the lender, not for you. It's the big banks and credit card companies who pay big bucks to the credit bureaus, not individuals like you and me. The higher your score, the more they will lend you. The more you borrow, the more money they make. Credit scores are a marketing tool for the big lenders. A high credit score is not proof that you're good with money. A high credit score just means the bank thinks you're a good credit risk. That's why you don't want to devote all of your efforts to chasing the best credit score to the detriment of everything else. If you fall into the trap of getting lots of new credit and then you borrow too much, you may have a good credit score, but you could find yourself with more debt than you can repay. That's not good. So, the first thing I want you to do is figure out why you want to improve your credit score. Is it good enough for you to have a credit card with a small limit so you can make online payments or a hotel reservation when needed? Then a credit score of around 650 should be good enough. If your goal is to get a car loan or qualify for a mortgage, you'll want a higher credit score because, of course, a higher credit score will likely allow you to qualify for lower interest rates. However, you'll need more than just a high credit score to get the best rates. To qualify for a larger loan from a regular lender, like a mortgage at a bank, you'll need to think of the 2 + 2 + 3 rule of credit rebuilding. Most traditional lenders will consider you to have fully reestablished your credit when 2 years have passed since you finished your bankruptcy or proposal, you have 2 accounts active or established after your completion date, and each account has a credit limit of $3,000 or higher. To rebuild your credit, you're going to have to apply for new credit, probably starting with a credit card. Getting any form of debt puts you at risk. Credit cards are tempting. If you only remember one thing from this course, remember this. Credit cards can help you rebuild credit, but they can also get you into financial trouble again. Credit cards are a great substitute for cash, but they should not be used as a way to borrow. Their interest rates are too high. There are less expensive ways to borrow. As you work through these lessons, I want you to think of rebuilding your credit as something that should happen together with how you manage money and achieve your financial goals. No matter what, take on only the amount of credit you need and can manage wisely.